Hello, everyone. Today is April 4th, 2017. Hope everybody's having a wonderful week. It is time for the second quarter retirement and market update. And the sun is shining, so hopefully the winter is behind us and we can look forward to spring and a nice summer. Before we dig in, just a couple of quick updates. As you saw in the last quarterly video, I talked about a book I've just released, Stress Test Your Retirement, Creating a Plan for an Ever-Changing Economy. This is something I'm really proud of. I spent a lot of time putting this book together, and it is really I guess, a summary of a lot of the planning processes and a lot of the scenarios that I've went through over the last decade, and I'm really excited to share it with all of you. So those of you that have been coming in for annual reviews, I've been trying to get you a copy. Those that you are coming in the office in the future, I'll gladly get those to you. So if you know someone that would benefit from this book, just let us know and we'll get that out to them. As many of you have commented, yes, I have been on TV and trying to create a little bit more of a presence for our firm here in the Twin Cities Metro. Just this previous Saturday, I was fortunate to be on WCCO TV. Granted, it was Saturday evening and it was after the Final Four basketball games, but it was a great opportunity to get on and share some of our message. So you've seen me on WCCO, you've seen me on KARE 11, and you've seen me on Fox here over the past quarter. So you can always view these on our website, but you can also go to our YouTube channel. We'll also be posting this quarterly video on the YouTube channel as well too. So thank you for all the kind comments there. In this quarter's video, there are some various things we're going to talk about. I'm going to talk a little bit about some economic events of the past quarter, talk about the market performance as we always do. I've been hearing lots of questions and concerns about, is the market getting too high? Is it getting overvalued? I'll talk to you about that. And then lastly, with regards to just future retirement planning, talk about some slight changes in the healthcare environment, and then also some news on pensions out there. So nothing to be alarmed of. I'm just always out here trying to share some facts with each of you. So over the past quarter, we've seen the Federal Reserve raise Fed funds interest rates another 25 basis points to a range now of 0.75 to 1%. This is the third hike they've done since 2009, which is unprecedented because now we're almost approaching a decade since the Great Recession, as it's now referred to. But it's also the first time we have seen two increases in 3 months with an even longer time period. So remember, this is important, that markets tend to do better in rising interest rate environments versus not, because that means, because we're raising rates, that means the economy can handle some of those efforts, and we're trying to even out what's going on out there in the marketplace. Secondly, another comment I've heard is, boy, the markets are really volatile. To be honest, they're actually not, which is sort of shocking. I think the problem is that we see so much news revolving around the presidency and everything else, with media sources trying to compete with each other, that the media is what's volatile. There's so much news out there, which is really difficult to combat. So just here a couple weeks ago is we snapped a 109-day streak. Believe it or not, this is amazing. We went 109 days without a 1% down day in the S&P 500. Keep in mind, that is over 3 months. This is the longest streak since May 18th, 1995. So this is all positive, right? That means that there isn't a lot of volatility. There isn't a lot of negative posture in the markets. I see this as all good signs for all of us as investors. So let's dig into the actual numbers themselves. So when you employ risk management in the form of asset allocation, which is what we really believe in as an office, is that you're always apologizing for some asset class that does not do well. You look at about every piece of research and study, and you just look at the markets as a whole. It's practically impossible to time the markets exactly. So asset allocation is the next best way to go. So one thing that we've always, or what I've been talking about a lot recently, is that emerging markets and international have been laggards the last couple of years because U.S. large cap has done so well. Well, finally, we're starting to see, not necessarily a shift, but we're starting to see some catch up. So you can see that what we consider developed international, predominantly Europe, etc., up about 7.5% through the first quarter. But then we look at emerging markets, which is Brazil, India, Russia, China. Central America, Southeast Asia, we can see that those areas are up about 11.5%, which is considerably more than most of the major US indexes like the S&P 500 and the Dow Jones. So when you're looking at your portfolio through the first quarter, you're going to see some nice performance because we do have a nice, a fairly sizable allocation into those asset classes. And when we look down at bonds and fixed income, we're also seeing that they're doing their part here in the first quarter as well too. So let's look at some current valuations, right? I have fielded probably a handful of calls just in the past few days from people who are saying, boy, isn't the market getting overvalued, or isn't there some level of concern where we're at? And the answer is not really. So the markets, yeah, they may be slightly overvalued, but overall, it is not that far off of historical levels. So this is showing the S&P 500 over basically the last 20 years. And when you look at the current price to earnings ratio, you can see that we're currently at 17.5, which by historical standards is kind of in the median range, and I'll show you that to you in a second. But what's interesting here, and I think this is a big reason why the markets continue to be strong, is when you look at dividend yield, the average dividend yield today is 2.1%. In 2000, it was 1.1, and 2007 is 1.8. So the dividend yield is actually still higher today than it was in the two previous market tops. And on top of that, interest rates are lower. So if you think about where's money flowing, is people are going to say, well, do I want to buy a more of a safer vehicle earning me 2.4, or I can get close to that with 2.1, but I might have some upside. So think of a company like 3M, for example. So we look at price to earnings ratio historically, you can see the standard deviation of where they fall. So what you'll see here is that we are still in basically the average is 16, we're at 17.5. So by no means a drastic overvaluation. Is that what we see when even in this chart is that the markets need to go from one extreme to the next, right? So they're not just going to say, oh, the markets are fairly valued and then just trade in that range. We always see things go from one extreme to the next. And if we were to look at a couple other ratios like dividend yield, you can see that we're right in line. Price to book ratio is right in line. Price to cash flow is slightly higher, but again, not by any drastic measures. And then we use what's called CAPE, which is a ratio created by Robert Shiller, who's a Yale professor. You can see that we're slightly overvalued. However, there's really no strong correlation to this being relevant with timing of when the market corrects. So I would say overall the market is not all that valued. But on top of that, what we're seeing is earnings are continuing to increase in the S&P 500, because that's what's important, because that's what's driving most of these valuations. So as long as earnings can couple that, I feel very positive about the market and the economy over the next year to two. And again, additionally, the energy sector has really been hurt over the past couple of years, and that's a good chunk of the market overall. So in my view, a very positive thing to look at. So next, let's shift to healthcare. This is a chart I had up in the last quarterly video that we did. And this is just showing how relative to other countries, how much more expensive our healthcare is and how it increases as we age. To me, this is really the big problem when it comes to trying to reform healthcare or make it more cost efficient for everybody, is that we just, by and large as a nation, have created a whole industry around healthcare, and it is more complicated than just trying to recreate how we provide healthcare coverage. Is the Affordable Care Act different from Trump's plan? I mean, really, those probably in the big picture things really don't have a huge impact on the cost of healthcare. It's really under the hood all the different things from cost from different providers to the companies to the amount of legal lawsuits. There's endless factors that play into this. But most importantly, it's a demographic shift. Is when you think about all these baby boomers that are retiring, we hear the number of 10,000 a day. That's really what's driving the cost, right? So most baby boomers have been contributors to the healthcare system for decades, and now they're recipients. And so we need to be replacing those people. We just can't replace them at a fast enough growing rate when it comes to the amount of coverage that they need. So from a planning perspective, we're continuing to anticipate healthcare to go up over the course of time. As you always see, we use a lot of JP Morgan slides. They do a great job of getting Michelle and I a lot of different research. And we're seeing here that currently the average 65-year-old is spending about $51.40 on healthcare costs in retirement, post 65 Medicare. And when we look at it, 6.5% growth rate by age 85, that'll be $18,000. Now we're using a little bit higher number on our estimations today, but we're using a lower inflation rate. And what's interesting is when you project this out, we were within a couple $100 of this projection. So basically, it solidified the work that and research that Michelle and I have done, and makes us feel confident that our projections are in line with what other experts are seeing as well too. Scary numbers, but realistic. So we need to make sure that that we're planning for that. Lastly here, some changes to pensions. This isn't a big deal, but there was a nice Wall Street Journal article, and actually a couple of clients had pointed this out to me that they had read it, is that slowly some insurance companies are starting to take over pension liabilities as a new business or avenue for them to expand their insurance company. Now, as we're seeing here in 2016, just under $15 billion have been pushed over to insurance companies, and for this year 2017, and that's expected to grow between 14 and 16 billion. So in the grand scheme of pensions, it's extremely small, but we're starting to see a small shift there. I wouldn't be surprised if we see more of that. However, of most of these pensions that are being shifted, they're 100% fully funded. So it's not like it's a poorly run pension that's being transferred. It's usually the company wanting to reduce their business risk and realizing they're not in the business of insuring pension liability, so they'd rather just pass that on to another company. That's really the reason behind this. And then lastly, I showed this slide in the last quarter, and I think it's a good reminder. What it shows is retirement savings by age group. So for many of you, you fall into that maybe that 55 to 64 age group. You can see that the average retirement account is about 104,000. So you see all the numbers of how much does an average retiree save, and in all categories it's almost not enough. So just thought I'd share that with you. So in conclusion, market volatility all exists. The media makes it more difficult for us to avoid today. This is especially true when I talked about the actual reality of volatility and how much the media is making us believe that there's volatility out there. It's just not there right now. The best way to combat this is to have a long-term strategy, to have a plan. The importance of asset allocation. All these things are really, really important. So with that, I thank all of you that have referred us clients over the past few months. I really appreciate that. I appreciate all of you for instilling your trust with us. I hope you have a wonderful rest of 2017, and don't keep us a secret. Take care.